Most traders don't lose because their strategy is bad. They lose because they're looking at the wrong time frame. One chart says buy, another says sell, and suddenly, the market feels completely random. But once you understand how professional traders read multiple time frames together, the chart starts making a lot more sense. In this video, I'll show you a simple top-down analysis process that helps you find direction, key levels, liquidity zones, and high-quality trade setups without turning your chart into a mess. What's up, everyone? Welcome back. Today, we're breaking down one of the most important skills in trading, combining multiple time frames the right way. We'll use price action and smart money concepts together to build a clean and structured market analysis from the higher time frames all the way down to the entry level. By the end of this video, you'll understand how to find the overall market direction, where major supply and demand zones matter most, how higher time frame levels affect your trades, and how to improve entries with better confirmation. And trust me, once you learn this process, your chart analysis becomes much clearer and way more confident. So if that sounds useful, drop a like, subscribe if you're new, and let's get straight into it. What is top-down analysis? Top-down analysis is simply the process of starting from the bigger picture and gradually moving into smaller details. Instead of jumping directly into a 5-minute chart and guessing what the market might do, you first analyze the higher time frames to understand the overall structure. Think of it like using a map. The higher time frames show the full city. The lower time frames show the streets. When you combine both properly, your decisions become much more accurate. But here's where many traders go wrong. They try to apply every concept they know on every single time frame. Support, resistance, order blocks, liquidity, trend lines, indicators, fair value gaps. And by the time they reach the entry chart, it looks completely unreadable. This video is about simplifying that process. I'll show you exactly what to focus on at each level so your analysis stays clean and effective. Why multiple time frame analysis matters. 1. It solves directional confusion. Let's say you're looking at a 5-minute chart. Price is moving up, then down, then breaking structure both ways. Everything feels choppy. You can't tell whether the market is bullish or bearish. But the moment you zoom out to the 1-hour chart, the picture changes completely. Now, you can clearly see the overall bearish trend and the selling pressure controlling the market. Suddenly, those random movements on the 5-minute chart make sense. This is why higher time frame bias matters. If the bigger picture is bearish, lower time frame sell setups become much more reliable. Whenever the market feels confusing, there's a good chance you're simply focused too closely. Zooming out often gives you the clarity you need. 2. It improves accuracy. A small move on a higher time frame can create a massive reaction on lower time frames. That's why checking higher time frame levels before entering a trade is extremely important. For example, imagine price creates a strong bullish setup on the 1-5-minute chart. You spot a clean order block. There's a fair value gap. Everything looks perfect for a buy. Then suddenly, the market reverses hard. Why? Because price reached a major resistance level on the 1-hour chart. The lower time frame setup looked strong, but the higher time frame level had more influence. This is exactly why traders should always ask, how much room does price actually have before hitting a major level? That one habit alone can help improve targets, tighten risk management, and avoid unnecessary losses. Now, let's look at the opposite scenario. Suppose the 1-hour chart breaks structure with strong momentum and leaves behind inefficiency. Price pulls back into an order block. Looks like a potential long setup. But before entering, we check the 4-hour chart. And now we notice something important. The market recently broke above major supply zones, meaning buyers are still in control, and there's plenty of room before the next resistance area. Now the trade has alignment, higher time frame direction, lower time frame setup, clear target. That combination creates much stronger opportunities. 3. It helps optimize entries. Another huge advantage of multi-time frame analysis is precision. Let's say you want to buy from a higher time frame demand zone. If you enter immediately at the top of the zone, your stop loss may need to be very wide. Instead, you can drop to a lower time frame and wait for confirmation. Maybe price forms a change of character. Maybe liquidity gets swept first. Maybe structure shifts bullish. That confirmation can help you enter at a much better price with lower risk. And more importantly, it gives you confidence in the trade. One thing many traders forget is that backtesting matters just as much as strategy. Before risking real money, test your setup across different pairs and market conditions. Study how the strategy performs historically. That process helps you build confidence, understand weaknesses, improve risk management, fine-tune entries and exits. Trading without testing is basically guessing, and the market punishes guessing very quickly. If you've made it this far, comment below. What time frame do you struggle with the most? Also, let me know if you want a deeper breakdown on order blocks, liquidity concepts, fair value gaps, or lower time frame confirmations. I might cover them in future videos. Hopefully this video helped simplify multi-time frame analysis and showed you how to read the market with more structure and confidence. Remember, the goal is not to predict every move. The goal is to trade with alignment, patience, and clear confirmation. If you enjoyed the video, make sure to like, subscribe, and turn on notifications so you don't miss the next upload. Thanks for watching, and I'll see you in the next one.